So welcome to this video. In this video we are going to discuss about compounding and discounting methods. So these are the basic methods that we are going to use in lengthier problems. So ensure that you understand the basics of compounding and discounting methods. So we'll start from the compounding. So in compounding interest we will first start with the simple interest concept. So simple interest is directly calculated on the principal alone. Okay, so this is the formula. The FE represents the future value, the value that you are going to receive in the future. So it is based upon the principal plus the interest. This is how the interest is calculated. The principal into the rate of interest into the n number of years. So we'll start here. Simple interest. What will be the amount an investor will have in 5 years if 1000 is invested today at an annual simple interest of 9%? So we'll start like this. So the future value that the investor will receive is the P plus P into R into N. So the P here refers to the principal, which is 1000, plus another 1000 for the principal into the rate of interest, which is 9%, into the number of years, which is 5. So we'll add, this is the principal part 1000, the interest part will be 450. So the total amount will be 1450. So this is about the simple interest, where the interest is simply added on the principal directly, and for the any number of years it's just kept on multiplied. So that is the simple interest. We'll move on to the compounding. So in compounding we'll use the same question. What will be the amount an investor will have in 5 years if 1000 is invested today at an annual compounding interest of 9%? So we'll have the same numbers, but we'll see like how compounding works. So this is the concept in compounding. Interest is calculated directly on the principal and interest. So in compounding interest, the interest is not only calculated on the principal, but any extra interest that has accrued on the previous year. Okay, so the formula works like this. The future value is equal to the principal into 1 plus R to the power of n. So where P is principal, R is interest rate, and n is the number of years. So we'll start. So in a problem you might also have something called as a nominal interest. So nominal interest is what will be paid for the bond holder and debenture holder. So ensure that you understand that the interest, nominal interest are all same words. Okay, so we'll start with this problem. So it works as future value equals to P into 1 plus R to the power of n. Okay, so here P refers to 1000 into 1. So within the formula the 1 is also the represents the P, plus the R here is 9% to the power of n is 5. So our answer will be 1000 into, for this you have to, this becomes 0.9 to the power of 5. So we will solve 1.09 to the power of 5, 1.538. So the total amount comes to 1538. So when you look at the numbers here, the compounding interest will always be higher than the simple interest. That's because in simple interest the interest is calculated only on the principal, but in compounding interest the interest is calculated on the principal as well as the previous year interest. So normally compounding interest will be higher when compared to simple interest. So the next topic is called as compounding effective interest. So here what happens is, effective interest rate is usually stated for a 1-year period in documents such as bond and debenture, but the actual interest paid differs with the invested period of time and compounding. So what happens here, normally interest is paid on a yearly basis. Okay, once in a year interest gets paid, but what if interest gets paid 2 times in a year, bi-yearly, or 4 times in a year, quarterly, or 12 times in a year, monthly basis? So if the interest is going to be paid on these kinds of time scales, then the effective interest will be differing from the interest that is mentioned on the bond or debenture. So we'll find out the effective interest rate. Okay, so we are not going to apply for the principal, it's only for the rate. Okay, so we'll start 1 plus I refers to the interest, so interest is 10%, so we'll take it as 0.1. Okay, M refers to the number of compounding. In a yearly there's only one compounding, so we'll divide it by 1 to the power of the number of years this interest we are going to get is only 1 year, and into M is always 1 here, so we'll get the answer. The answer will be 1 plus, if you divide it by this will be the same 0.1 to the power of 1, so the answer would be 1.1. so this will be your effective interest. Okay, but if you're going to do in the case of A, okay, for example bi-yearly, then your answer will be like differing. We'll see how it differs. So bi-yearly EIR, so we'll start now again the same 1 into 0.1 is the interest divided by number of compounding. Interest is not going to be paid as 10% in a year, but in two times you will be paid 5%, right? So it's divided by 2, so there are two compoundings, div into yearly we are going to get only one amount, and that compounding is into 2, so the numerator tells you how many times you are going to get the interest. So you'll solve this, the answer will be, it would be 0.05 to the power of 2. We get 0.1025, so our answer will be 1.1025. that is our answer. If you see this answer and this answer, okay, it will differ because here only one time you are going to receive the interest, but here you are going to receive the interest 2 times. So here it is only like 10%, okay, additionally that you get as interest, but here if you see it's 10 plus 25, that is the interest that you are receiving. So in essential we can put it like this, here you are not going to receive the 10%, you are going to receive the 5%, okay, at 2 installments. So that is what happens in bi-yearly EIR. So we'll work out the quarterly EIR and the monthly EIR. So we'll work it out here. So we'll work out the quarterly EIR. Okay, so quarterly EIR is we are going to receive an interest like not 10% but 2.5% at 4 installments. So that is what this formula tells you. So we'll start. So the formula again works like this, 1 plus 0.1 divided by M here refers to 4 into 1 into 4. So that is what the formula is. So if we solve this, we'll be like getting an answer like this, 1 plus 0.025 to the power of 4. So we get 1 plus 0.1038. So the total answer will be 1.1038. We'll do the same for the last part, that is the monthly basis. So monthly EIR refers to we are going to receive just 0.833% of interest, okay, at 12 installments. That is how it works. Okay, so how does we get 0.833 and 12 installments? We'll do it again. So again the formula is 1 plus, see the interest is 0.1 divided by 12 months into every month we are going to get an interest. So it works like this, 1 plus, so we'll get an answer like this, 0.1047. so the answer will be 1.1047. so our total answer is 1.1047. so if you look at the movement of this problem, you will see that If you're going to receive the same 10% in one installment, it's going to be 1.1. If you're going to receive the same 10% in two installments or 5% in two installments, then the interest will be lightly going up. And if you're going to receive the 10% in four installments of 2.5% interest, then it goes to 1.038, a little bit higher. And in the last one, if you're going to receive a monthly EIR, so it goes to 1.1047. So even though it is the same 10% in all the questions, okay, how many times you receive the interest in a year determines like how little bit percentage you additionally earn. So that is about the effective interest rate. We'll move on to the next problem. So the next problem is called as discounting. So discounting is a very important concept, so ensure that you understand this concept really well. So we'll start with here. The value of money keeps going down if it is not invested. So why is it so? It's because of inflation, we can say. Okay, because the inflation, the money keeps on going down. Thus the value of rupee 1 will be less after 1 year and very less in 10 years time. So every year the value of money keeps on going down. Discounting tells us what is the worth of 1 rupee which is received in future or in 10 years time. So assume that someone gives you 100 rupees today. That 100 is very much worth than 100 that you are going to receive in 1 year, or 100 that you are going to receive in 10 years. Okay, so what happens is the value of money in today's term is high. In 1 year term it goes a little bit low, but in 10 years time it goes very low. So the time value of money or discounting tells you that the amount that you're going to receive in 1 year time, what is its worth today, or the amount of money that you're going to receive in 10 years time, what it's worth today. Okay, so that is what discounting is. If you look at the formula is present value equals to future value divided by 1 plus r to the power of n. This formula is not new, it's just a compounding formula. In compounding formula you had future value equals to present value into 1 plus rn. So what happens is this PV remains here, but this 1 plus rn goes as a denominator here. So it becomes 1 plus r to the power of n. So this is not here anymore. So look at now, you will get the formula. So PV equals to FV divided by 1 plus rn. So both the formulas are same. What number you want to find out, that determines the formula. If you want present value, then it's discounting. If you want future value, then it is compounding. So we'll start from a problem. Okay, given a discount rate of 9%, calculate the present value of $1,000 cash flow that will be received in 5 years time. So we have to find out what's the present value equals to the future value, which is 1000. Will work as per the formula, divided by 1 plus 9% to the power of n. N is the number of years, so it is 5. So it will be 1000 divided by 1.09 to the power of 5. So again 1000 divided by 1.5386, so 649.9. okay, so if you're going to receive 1000 rupees from someone, okay, in and the discounting rate or the inflation rate in the country is 9%, and in 5 year time you're going to receive the 1000 rupees that they give in 5 years is only worth up to 649 in terms of today's amount. Okay, so this is how you solve the formula. But you might wonder like how this number came. So you can also get this number like this: 1.09 into 1.09 into 1.09 into 1.09 into 1.09. If you do, you will get this. As this is very tough, okay, it's better to do this one. So to do this one, you can just take 1.09. okay, say take a scientific calculator and put the power button like this, okay, and put 5. So you will get the, and put an equal symbol, you will get this number very quickly. But you won't get this symbol in a normal calculator. So that is a problem. So doing this approach is tough. Doing this approach in a normal calculator is not possible. Okay, you have to have a scientific calculator, then only you can do it. So there is a much easier way to do this. So we'll look at that. So we'll again do the same logic with the table. So take the 1000 and just multiply, rather than divide, multiply it with the present value table, okay. And in present value table, what you have to look, 9% for 5 year, you have to look that. So we'll try to look that and get an answer. 9%. So this is a present value table. So here on one side you have all the periods, on the other side you have the discounting factors. So our job is to find out the 9% number for 5 years. If you look, it comes to 0.65. so we'll take that number. So 0.650 was the number. You should always take after decimal 3 numbers while using a present value table. That is like very important. Use 3 numbers after decimal. So look at the number, we got 650. So this 650 is the same as what we did earlier, but it takes a very shorter amount of time. So you should be able to do it in 2 ways. One, either through looking at the table or using the power function in your scientific calculator and quickly getting the number. So ensure that you have understood this, and we'll go to the next problem. So the next problem is PV of a series of amount, a present value of series of amount. An investment is expected to produce the cash flows of 500, 200, 800 at the end of next 3 years. If the required rate of return is 12%, what is the present value of this investment? Okay, so he says that we are going to receive the cash always in the end of the year. So as per the assumption used in this calculation, okay, the assumption that is used here is the 0th year. The 0th year refers to the starting of year 1. So that is the starting of the first year. What's the first year then refers? The first year always refers to the end of year 1. Okay, so the same logic keeps on continuing. So for second year, if you take, second year is nothing but end of year 2. So if you assume this to be January 1st of the year 20, this is going to be December 31st of the year 20. Okay, this is going to be December 31st of 21 year. Okay, so that's how it keeps on rolling. So if they say first year, it is always the first year end. If you say second year, it is always the second year end. If you say the cash flow is received at the start, it is called as the starting of the year or the 0th year. Okay, so ensure that you understand this concept really well. And also the first year is represented as December 31st 2000, but we can also say that it can also be January 1st of 21, because there's just a 1 day difference between the both. So we can also say that if they say the cash flow is going to be received on January 1st 2021, then that is the same as December 31st 20. So if you say that January 1st 22, that is like similar to this number. So if a problem states that the first year cash flow is received on Jan 1 2020 and the other cash flows are received at the end of the year, so these are the end of the year, it can be year 1 and year 2. If a problem states that the first cash flow is received today, and today is January 1 20, that is today, and the next cash flows are going to be received in the starting of the year, so 1st January 21, 1st January 22, if it states like that, then there is just a 1 year difference between the both. If this refers to the 0th year, okay, the 1 year cash flow that is received will be called as first year, and the second year cash flow will be noted as the second year. Okay, so that's how it works. So we'll move on to solve this problem. So we'll set up a table. So we had 3 years, 1, 2 and 3. We look at our cash flow. Our cash flow are 500, 200, 800. So what is the discount factor? For discount factor, we can actually look at the table itself. So the first 3 years is 1, 2, 3. So these are the numbers. So these are the numbers. Okay. So we'll multiply and we'll get the answer. Just multiply this cash flow into this number and you'll get the answer, because this is the first year discount factor, this is the second year discount factor, and this is the third year discount factor. The sum has indicated that the cash flow is received at the end of the next 3 years. So end is first year end, second year end, and third year end. So the discount factor is also how we received first year discount factor, second year discount factor, and third year discount factor. So the total comes to 1175.5. So that is the total of present value. So that's how we got it. So should we always look at the discounting factor table or the present value table and get the numbers like this? The answer is no. There is also another way to do it. We'll just do it now. So what you can do is, for the year 1, year 2, and year 3, you can do it like this. Take the number 1 divided by 1.12. Okay, you will get a number. The number that you will get is 0.893. Take that number and use again divided by 1.12. You will get 0.797. Again take the 0.797 and divided by 1.12. You will get 0.712. So without looking at the table, this is a much quicker approach. So you take the first number divided by 1.2, you get this number. Take this number as a numerator, again divided by this, you will get another number. Keep on doing it repetitively, you will get the numbers that you require. This can be done for around some 5 years or numbers or 5 iterations. But if it's going to be a lengthier sum, something like 10 years, then we have to look at the discount value, the present value table. So ensure that you understand this. Assume the same question, instead of giving you 12%, they give you something like 5%. Then how do you divide? If the question is giving 5%, you have to use it like this: 1 divided by 1.05. If they give you 10%, you divide it by 1.1. If they give 12%, you keep dividing it by 1 divided by 1.12. If they give you 20%, then start with 1 divided by 1.2. Okay, so you move in this order, you'll get the answers. So always start, this will be the first year number. Okay, this will be the first year number, and keep on doing it iteratively, so you'll get the other year numbers like this. Okay, ensure that you understand this concept so that it's easier when you go in for a lengthier problems. So we'll move on to a next problem. It's called as annuity, present value of ordinary annuity. What is the PV of annuity that pays 200 per year at the end of each year for the next 3 years, given a 6% discount factor? So he says, assume that someone pays you 200 rupees at the end of each year for the next 3 years and the discount factor is 6%. Then what would be the amount that you receive so what is the value of that amount today? So that is what is the question is. So in order to do this, we'll use the same approach that we had in the earlier problem. So what we'll do, we'll have years, we have cash flow, we'll have discount factor at 6%, and then we'll have the present value 1, 2, 3. Cash flow received is 200, 200, 200. The answer for 6% would be, so this is the discount factor, so we'll multiply, we'll get the present value for each year. So this is the total present value of the annuity. So the total present value of annuity. So now the question arises, what is an annuity? Okay, see, annuity is any payment or income which is fixed in amount and received or paid over a number of years. That is, very simply, if you're going to receive or pay a fixed amount of money, 200, 200, 200, the number doesn't change, every year it is 200. In that case, it is called as an annuity rather than a cash flow. Okay, that is annuity. So should you do so much of iterations and then get the number? The answer is no. If the amount is going to be constant and it is an annuity, there's a simpler way to get it. So we can put it like this: present value of annuity equals to the cash flow into annuity factor for discount factor percentage at n years. That is, we'll simply put it, the cash flow here in the sum is 200, multiply it by the annuity factor for 6% into, so we have to look at annuity factor for 6% at 3 years. If you look at that, you will get the answer. So let's look at that factor. An annuity factor table similar to the present value table, you will get in an annuity factor table this side as the percentage and this side as the number of years. So our job is to look at 6% and at 3 years. So that comes to 2.673, and let's get the answer, 534.6. If you see, this answer is the same as this answer. That is, if you're going to work out for an annuity, there's no requirement that you have to do a table like this and do it. You can just work out in a simple line and directly get the answer. If you're very comfortable in getting the annuity, you don't even need to show this writings and all. You can directly multiply 200 into 2.673. You can directly get the answer. It is as very simple as that. So ensure that you understand annuity, so that in exam what they do is, in a lengthier problem, they'll simply give you 200, 200, 200 like this. Okay, for 5 years they might give you, and if you do this through a table approach, it will take you around 10 minutes, but if you do through this one, it will take you 1 minute. So they indirectly test whether are you capable enough to understand what is an annuity, and do you know how to use an annuity factor and quickly solve the problem. So that is what they are testing in an exam. So ensure that you identify an annuity very quickly and you use the annuity factor table very quickly and get the answer. So that is what your job is. The question will not ask you find out the present value of annuity. That's very simple. So they'll only indirectly test you. Okay, so we'll move on to the next problem. So annuity received at the start of the year. What is the present value of annuity that pays 200 per year at the start of each year for the next 3 years given a 6% discount factor? This sum is the same numerical sum as the previous one, but the only difference is in the last sum it was the cash flow is assumed to be receiving at the end, but here it is at start. So if we do a table, we'll start with the table. So again we'll have year, we'll have cash flow, we have discount factor at 6%, we'll have present value. Take year. See, the year will not be 1 because it is at the start. So if it's going to be started, assume that he's going to pay you on this date. We'll have some dates. So assume the first cash flow is received today. Today is 1st Jan 2020. So the next payment is going to be received on 1st Jan 2021 and then 1st Jan 2022. See, today any amount that you receive will be noted as 0th year. The next year then will be 1st year, then the next year will be 2nd year. Okay, the cash flow that is received is the same 200. Factor for the 0th year is always 1. Okay, from there on you get the decimal numbers and you can do it. So this will be 943 and this will be 890. So you'll multiply and get the numbers. This will be 200, this will be 188.6, this will be 178. So if you add all of them together, you will get 566.6. So that is the present value of annuity. We have got this number. So can we do a shorter approach and find it out? Yes, we can. Present value of annuity. We'll find out the cash flow multiplied by annuity factor for discount factor percentage at n years. So we'll take this as a concept and then we'll do it. But when we do this, we won't get the answer. Why? Because this was used when the cash flow is received at the end of the year. When you receive at the beginning of the year, the formula changes. So how does the formula change? The formula works like this. See, this is multiplied by add 1 plus, because the 1 that you are using here, this 1 is taken here. So 1 plus annuity factor for a discount factor, that is 6% at n years. If you put n, then it becomes 1, 2, 3 years. 1 has already been added here. So how can we take 3 years discount factor? We have to take only 2 years discount factor. So what we'll do, we'll change the formula a little bit. The formula is n minus 1 year. Okay, so we'll do this and we'll try to get an answer. The cash flow is the same, 200 into 1 plus annuity factor for 6% at 2 years. So that is what we want. So we'll find out that number. So that will be 200 into 1 plus some number. So what is that number? We'll look at the same annuity table. So for 6% for 2 years, it is 1.833. It will be 1.833. So our number will become 200 into 2.833. So our answer will be 566.6. So if you see, this answer is similar to this answer, but this is a shorter approach. Ensure that you understand this formula really well. Okay, this is when annuity is received at the start of the year. Okay, you can use this formula. The earlier formula was for the end of the year. So we'll move on to something called as a perpetuity. What is a perpetuity? Perpetuity is an annual cash flow that occurs forever. That is, if someone pays you a money forever, what is that instrument's worth is? So it is present value equal to annual cash inflow divided by a rate, that is a discount factor. So essentially this is a formula where there are 3 elements. Okay, one of the element will be missing in the question. Your job is to find out that element. So we'll start. PV of a perpetuity. Condon Corporation issues preferred stock that will pay 4.5 per year in annual dividends beginning next year. Okay, beginning next year is it's the first year. So this year end or next year beginning is the both same. So it is the first year, and plans to follow this dividend policy forever. Given an 8% rate of return, what is the value of Condon's preferred stock today? So we'll work out like this. What is this 4.5 refer? That refers to the annual cash inflow, right? What does this 8% refer? 8% refers the rate. And what we have to find? We have to find out the present value. So present value will be $4.5 divided by 8%. So your answer will be 56.25. Okay, that is the present value of perpetuity. We'll move to the next sum. An investor is planning to buy Condon preferred stock that will pay 4.5 per year in annual dividends beginning at the next year, and plans to follow this dividend policy forever. Determine the rate of return that an investor would realize if he has paid 75 per share for the stock. So here if you say this 4.5 is the dividend, so that will be the annual cash inflow, and this 75 is what she has paid. Okay, so that is not the rate. The rate is what you have to find. So this actually is the present value. So we can put it like this. So the present value equals to annual cash inflow divided by the rate, where the present value is 75 the annual cash inflow is 4.5. The rate is what we don't know. So what we'll do is we'll try to find out the rate. So the rate will be 4.5 divided by 75. So that will come to 0.06. So if you represent it as a percentage, it would be 6%. Okay. So or else you can put like this, 0.06 into 100, that gives you 6%. Okay. So that is what happens. So in this formula, any one number will be missing and you have to find out the missing number. That is called as perpetuity. So thank you very much for watching this video. We'll meet in the next video.